How are you, Jamie?
Good, thanks. Good, thanks. Looking forward to this. Thanks for having me on again.
You're welcome. We have some things to cover, and
Yes, I've
Fed
just been
next.
listening to the conversation. Fantastic conversation. I think you're hitting all the main points there. Debt ceiling is coming on everyone's radar, isn't it?
Yeah, and really the narrative is pretty complacent. They'll be theatrics. It'll get done. Eh,
Listen,
What do you
history would
think?
suggest. I think history tells you that's exactly what's going to happen.
Right.
They haven't ever not done it. In fact, I wrote about this a couple of weeks ago, and here's one for you. Here's a question: how many times since 1960 do you think the debt ceiling has been modified, tweaked, or raised, or postponed since
In
1960?
60 years,
Yeah, just over
six,
60.
60 times.
Not bad. 78.
So even more than once a year.
Exactly. So on average, so these things, that tells you that obviously they come up with unnerving regularity, but every single time, it is, as one of your
Yeah.
panelists said earlier, it's kicked down the road, and especially with an election year coming, you would think that's the case. However, this time could it be different? I was just as you guys were talking, I was looking at a chart of a spread between the 1 month and 3 month US T bills. Now, obviously, if it's at the very short end, they're very close in
Right.
maturity. In normal times, the spread should be a couple of basis points max. Sometimes it goes out to 5, 10, 15 basis points. Do you want to, again, another test for you? Do you want to know the spread on the 1 month and 3 month T bill now?
50.
I know.
Full point. Okay, these
Tell
guys
me,
know.
tell me.
145?
180.
80. Ooh.
Oh my God.
So that tells you that the market is clearly, maybe it is looking at this time is different. Certainly, it's not taking any chances, and it's people are piling into the 1 month because it doesn't
Yeah.
it
No
doesn't cross
risk.
over the expected X date, which we think maybe June, July-ish, maybe August. But the 3 month, nobody wants to touch it, and the spread is just completely exploded. And I think that gives you an indication
So
of how nervous
so
the market may be getting.
so when I was a younger trader, they used to have this thing called the TED spread.
Hmm.
They still have it, T-bill zero. Do people trade the TED, or did the just the duration trade take it over?
Didn't
But it
the
was a
TED
flight to
spread?
quality spread. Yeah.
Yeah, but didn't that sort of go extinct after the great financial crisis? Was that the LIBOR? Was that treasuries over LIBOR? Was it
It was T-bills against
T-bills over?
euro dollars, and they both traded at the CME. The euros
Right.
traded at the CME, and the T-bills traded at the CME.
Well, I think
So
again, just before I came on, I was looking at the T-bill OIS spread, which I think may be a kind of proxy for that. And
okay.
again, you'd expect it 3 month T-bills and 3 month OIS, you'd expect to be virtually identical. Again, that spread is, I wouldn't say it's blown out, but it's moved out to about 15 basis points, 15, 20 basis points,
Okay.
which, for those instruments is a wide spread.
And yet that fear is not being expressed in VIX, in equities, even different
So,
bonds like the HYG holding up better than sovereigns. Almost
if
has
some,
a
yeah,
outperformance in HYG. So
yep.
one side saying take no risk with sovereigns, and everything else I just mentioned says take risk.
Yeah, that's, I mean, if somebody can explain to me that and also can explain to me why the VIX is about, well, last I looked, 16.7, 16.8.
It
I
wasn't
think
this low, even at all-time highs in the market in late 21. It wasn't this low.
it's below the average of almost every single time frame of average you can take since the VIX was launched, I think 1990. It's below the
Yeah,
long-term average.
yeah,
Now, I know that's implied vol and it's not realized vol, and vol experts and stock traders would know this better than me. But so it's not necessarily the best or the only gauge of volatility in the stock market, but it is extraordinarily low, and it does suggest some sort of complacency.
oh,
Um,
a little bit.
we're talking about the debt ceiling and all these risks, and yet since the banking shock low of about a month or six
Right.
weeks ago, the S&P 500 is up nearly 10%.
Yeah.
No,
It meant liquidity in an odd way. It brought, we had easier monetary conditions. So that was a go signal.
Liquidity injections are good for markets, yeah?
Yeah, I think that, if you're hooked on heroin, you need an injection to be able to function. Right. Anyway,
I would guess, but yeah. So
I'm not saying
dynamics. These are some of the market quirks that we have as we go into. You mentioned some of the events. We've got the Fed coming up.
Talk about quirky. Let's talk about the Fed. They're the quirkiest bunch around.
Even quirkier than the Bank of Japan.
Yeah, I'd call them pretty quirky.
Well, the Fed, I think it's, you guys can see the screens. Of course, we're looking at one and done. The market's pricing up, I think, one more hike, which would probably come in a couple of weeks. Or is it next week, actually? Technically, it's next week.
Yeah.
And that seems to be the market pricing. And then I suppose the question is, well, two questions. One, is that going to be the case? We've still got people like James Bullard. I think he was talking to us last week at Reuters, and he said he's still banging the drum for maybe another 50, possibly even 75. Maybe he's an outlier, and we kind of discount his views, perhaps. Obviously not consensus. On the other side, we've got Austin Goolsbee. He's talking about maybe pausing at this juncture. But I think that if we take the consensus, it's one and done.
He's a new guy.
Yeah.
Austin Goolsbee, huh? He's already couldn't wait for that microphone, could he?
Well, he's taken over. I think I'm right. He's the Chicago Fed, right? And his predecessor, Charlie Evans, he was extremely dovish. So maybe he's fitting into that slot. But if you take the consensus one and done, I suppose the question is, as it always is, really, is how soon does the Fed pivot and then cut? And consistently, I think last time I was on a few months ago, we spoke about this. No matter where the consensus is for the terminal rate over the last 6 months, year or so, no matter where the terminal rate has been forecast, the implied terminal rate, the forecast has also been for about 50, 75 basis points of cuts shortly after.
Yeah.
And that's exactly where we are today still. We're still looking at a terminal rate of whatever it is, 5.25%, but quickly followed by fairly substantial easing in the 6 months that follow.
So what would be the market reaction if, we get to the terminal rate and instead of going right to easing, we just, the Fed paused for 6 months?
That's a good question. And I'm not entirely sure of what that would mean, but you would think it would probably mean stronger dollar. If the Fed is higher for longer, then you would think it's dollar positive. But that's not what, we're talking earlier about history. That's not what history shows us. The Fed tends to, almost always, move from tightening terminal rate and then quickly, within about 6 months, move to easing. The main exception to that was, I think, 2006, 2007. Yeah, just before the rate.
Yeah.
There was almost a year, perhaps a year or more of plateauing it. I can't remember the rate. Was
because the market held, so they really didn't come in and start easing until the 08 the market sell off is when they started to do it.
Was that the jobless recovery? Was that what we termed it?
Yeah,
then?
Well, that was the GFC. So it took a year after they stopped before we felt the market felt the implications of what they had done. So maybe that's what's happening here.
But that's an anomaly. That doesn't happen normally. Over the last 40 years, the Fed has always turned pretty quickly. And I suspect we would not be in for a year of steady policy this time around.
Well, what do you think Paul is thinking? He sees the same things you and I do. He sees that spread between the 30 and 90-day T-bill. What's he thinking here with this going on?
Well, we had the minutes of the previous Fed meeting. The Fed last met, when was it? March 22nd, 23rd. That was when the Fed last raised rates. And there was discussion at the meeting of pausing. So it was discussed, but don't forget that was only days after the banking shock. So it's understandable that that came on the radar. It was very much front and center. It will be interesting to see how much that figures into the conversation next week. Obviously, by some metrics, things have calmed down. We've just been talking about the S&P's up 10% nearly. The VIX is down at multi-year lows. Markets seem to have calmed down. However, the emergency programs that the Fed introduced, their lending facilities in the wake of the banking shock, they're still in place and they're still being used, and fairly substantially as well. We're looking at $70 billion each week is being lent out to banks through the new bank term funding program. So that tells you that there's still some stress in the system, and I suspect the Fed will be obviously well aware of that. I think it will figure into their conversation next week. Will it be enough to make them pause? At this stage, probably not unless we get another blow up in the next week or so, the week 10 days. But I think it's very much on the radar. And as we know from history again, banking crises, they tend not to be resolved in a matter of days or weeks.
Exactly. And I think most people, when they say the banking crisis, it's like it's over. And I've heard that there are, many smart guys out there looking for vulnerable financial institutions right now to short or warn their subscribers. And US Bank happens to be one. I think Joseph Wang tweeted about someone that they're definitely a poster child for what happened at SVB and the way it's run. Then I've heard TD America and the bank in Canada is also under scrutiny.
Was that the most shorted bank? That a couple of weeks ago, that was one of the most shorted banks in the world, wasn't it? I think I saw some.
Was it TD?
So, yeah.
Okay, and so. Schwab. I mean, didn't Schwab buy them?
Well, Schwab was in the firing line, wasn't it? About 4 or 5 weeks ago, but that seems to have died down a bit. But you're right. Certainly, some of the smaller banks and the regional US banks are still under pressure.
US Bank is not a small bank. It's not a regional. I don't think they are.
No, sorry.
I mean, they're in trouble, and they're contributing to the bailout for Signature.
Gotcha.
So maybe it gives them, it's good PR. See what kind of shape we're in. We could lend money to a failing institution. That's how great our books are. But that's not what I'm reading.
Well, I
have an account there. I have an account there. What should I do, Jamie?
So you've got a vested interest then. Put it into short-term treasury bills.
Okay, you go right to the Fed to do that. I mean, how do people, John Q. Public, retail guys that, they're used to money market accounts or CDs. How does the average person get into T-bills? How do they?
You can buy treasuries, can't you? You can buy bills, you can buy treasuries. Retail investors can do that. And if you want near cash-like rates, I think you can go to Apple now and get 4.1%.
Okay. Go where?
Apple have just launched their new cash account. Yeah, so everyone's getting in on the act. Cash is almost 5%. You can stick it into savings, money market funds, as we've been seeing the last few weeks. Money market fund balances are over $5 trillion now. So
you brought up my favorite subject, Apple. Let me ask you something, Jamie. It's your fault. I say this: Apple is the whole banana.
I heard it the first time. Very good. Very good.
Oh, you did, but stock traders and everyone, it's their flight to safety trade. It's like the gold market is to it's the most crowded owned stock on the globe.
It is, and it's amazing how, as you say, it's more of a safety trade now, isn't it? It's a value trade. It's a flight to safety, liquidity. Only a few years ago, well, I mean, it's obviously still a big tech company. We don't usually associate tech with that, but some of the big tech, mega tech, is now kind of being treated as proxy for safety, for liquidity. It's the only
A in FANG and MAGA that hasn't been taken out to the woodshed.
Yet,
It's the only one.
Well, what tends to happen in crowded trades? They don't always stay crowded.
Yeah, we know how they don't stay
But
crowded.
I mean, again, maybe the exception. But just going back to the banks, I mean, yes, what I was trying to say earlier was, some of the smaller banks, the regional banks in the US, are still under pressure. I was just looking at this also before I came on. I think the regional banking index of US,
There you
regional
go.
bank. Well, there you go. It's down 20-25% still from the pre-shock, and it hasn't moved. I mean, it crashed and it hasn't come back at all. There's been zero bounce.
Okay, all right. So it had a car wreck, and now it's in shock, right? And it's just trying to stabilize. But bottoms are not formed like this.
So what does that chart tell you?
We could recover there. So you talk about the S&P's recovering 10%.
Yeah, nearly 8-9%.
This hasn't. No. I think that this could be the catalyst for either 4,300 if it continues to hold for the S&P, or for a decline in the S&Ps if we start making new lows here. How about you?
Well, I'm not a chartist, but that does not look good to me. I think my basic intuition is...
You wouldn't put your mom's money into the KRE today? Is that what it is, the KRE?
I would maybe wait for the next leg lower before thinking about that one.
Maybe this would be a better bet. It's called Syscoin. I'm kidding. A friend of mine's. Oh, look, it held the line. Anyway,
but what's interesting about the small banks and the regional banks is also how it's intuitive, of course, but how closely tied these institutions are with small businesses in the US. Yeah. And you may have seen it pass your screen. A couple of weeks ago, we had the National Federation of Independent Business survey. Not something most of us sort of who look at macro things would have looked at any point over the last several years. But it showed that, again, this was done just after the US banking shock. Sentiment fell in March, as you would expect. But if you look under the hood, some of the numbers, the numbers were really, really quite startling. And I'll just reel off a couple of you just to show how stressed small businesses are in the US and how that link with the small banking sector. If both of them are in trouble, then the economy is in trouble. I would say the net percentage of firms saying now's a good time to expand fell to just 2%, and that's the lowest since March 2009. So none of these businesses think now is a good time to hire or invest. And that's the second lowest.
Well, they can't find employees anyway.
But even if they could, their instinct, their inclination is to not expand, and that's the lowest, the second lowest rather, since the survey was launched. I think more than 40 years ago. Wow. And the share of firms, again, the net share of firms planning to increase their hiring was the lowest in 6 years if you exclude the pandemic. And the credit conditions index in that survey was the worst in over a decade. So you put it all together, you put the banking stress in that part of the banking world together. It's not a particularly encouraging outlook for the next, say, second half of the year.
Okay.
And also, just don't forget that the small firms in the US, small businesses, they account for about 40% of employment.
Yeah, so it's not it's kind of a toxic cocktail we have brewing here. So
it's one to watch, and that's something that the Fed will, I'm convinced, will be monitoring very closely.
Okay, so it sounds like there's plenty of economic justification for them to be easing right now.
Well, I'm certainly pausing,
except for inflation, maybe the stickiness of certain inflation like food and shelter.
Yeah. No question about that. But I was, again, just before I came on, looking at it's a proxy for sort of commodity inflation and energy inflation and broader inflation trends. It's just a proxy. But if you look at the year-on-year oil price, okay. I'm talking about Brent here. No, Brent.
Brent. Oh, so okay.
So a broader. But if you look at Brent, it may be the same for WTI. the oil price year on year has been negative since the turn of the year. So that's
Right.
4 months now of persistently negative year on year price action in Brent. It's now about minus 25%. It's got as low as about minus 35, 40%. So the inflationary impulses, if you look at that, are clearly disinflationary.
Yeah.
However, again, obviously there are other factors at play, and inflation broadly has been stickier than maybe the Fed would have liked. But that's worth bearing in mind as we, so base effects are bound to take effect. And again, that's something that the Fed will have inbuilt into their models, I'm sure.
This is an important level, it looks like, Jamie, in WTI that you talk about. This was OPEC's announcement. And
yes, it did spike. It's come off though, hasn't it?
Yeah, it's trying to fill the gap or coming off. So the next week or so is going to say, tell us whether or not OPEC was successful, or that was just enough for them to get some more oil off for a week or so at better levels. So
not quite short-termism. Well,
yeah.
as you said, as one of your panelists said earlier in your discussion earlier, the economic indicators have been very mixed in the last few weeks, and so much so that the City Economic Surprises Index has fallen to its lowest in over 2 months. So it's not a big deal. It's not a huge, historic low, but it's lowest in 2 months, and that shows that either expectations were maybe too high, or the data itself has, underperformed in the last couple of weeks.
Okay, so hard landing, soft landing, no landing.
I think the no landing stuff. I mean, have we ever had a no landing? There's always been. It's either been
only if you crash, and that's still a landing.
Well, that's a hard landing, I suppose, isn't it? Crash landing.
No landing. Yeah.
Not landing.
Yeah. So really, I think we've covered almost everything that we wanted to talk about, Jamie.
Well, as you say, we've got the Bank of Japan. We've got the Bank of Japan this week, and
yeah,
I think it's one of these things that attention will be focused on the Bank of Japan, no doubt about it. This is Ueda's first policy meeting as governor. It's a landmark one. It opens up a new chapter for the Bank of Japan, if not a new chapter, possibly a new era. However, it's unlikely he's going to kick off his debut policy meeting with a complete overhaul of YCC. So it will all be in the forecast. I think they revise their growth and inflation forecasts. Inflation has been stickier than they would have expected. Growth has been slowing. And it's all in the language and what he says in the press conference. Again, I think this is worth bearing in mind. If the Bank of Japan indicates that there may be some change to yield curve control in the coming months, which I don't think that would be unreasonable to expect. Contrast that or compare that with the timing of that with, as we were discussing earlier, what's happening in the US with the debt ceiling. If we go into the next 3-4 months with the Bank of Japan on one side making changes to yield curve control, and we've got a brewing crisis here in the US on the debt ceiling, I think that could create some fireworks in dollar yen.
Okay, and we've been trending up in dollar yen. You believe that it'll accelerate it or reverse it? Well,
I think just on the very basic premise of yield curve control change, or a shift from softer, easier policy in Japan to tighter policy,
it would take it down.
Yen positive. Yeah. US debt crisis, possible default, etc. What would dollar yen do? I think dollar yen would probably head to the downside on that one. However, last time I was on, I think I said dollar yen might go down, and it went to the moon. So take that with a pinch of salt.
It looks like it wants this level anyway. We'll see.
137
happens into about 137-ish. It breaks through that, Jamie, I think we'll see a 140 handle. That would imply the guy does nothing new and it's same as it ever was, right?
Well, he has said his few public comments so far have been that he's going to take it steady as he goes. There's going to be no major abrupt change, and easier policy will persist for now. But we all know that the pressure, especially in Japan, to have some sort of change is certainly building. And he might want to make his mark and make a break from the Kuroda past of 10 years of super loose policy. So again, I think it's worth watching the timing of that, what they do in Japan versus what's going on here with the debt ceiling. If any of that overlaps or coincides, dollar yen could get very interesting.
Okay, well, when economics look like a voodoo science and you need clarity, you go right to @Reuters Jamie on Twitter. And the best place to read your column, of course, is on Reuters. And really, Jamie, every time we talk, I feel like you've crystallized some things, and you definitely have, brought up some points I didn't know, that there really are some headwinds out there that, that say that the Fed should probably have stayed tight too long already.
Well, as ever with these things, only time will tell. And if it's looking at inflation, it does want to break the back of inflation. It's not broken yet. So, that's why they've stayed on that path, obviously. But there are other factors at play, and debt ceiling, banking system. Obviously, this is the most flagged recession in history, probably. So any slowdown or technical recession will come as a surprise to no one. But these shocks, debt ceiling, and the banking system stress, I think these are going to figure more prominently in Fed thinking, if not as early as next week, certainly in the coming ones.
There used to be a narrative that the Fed wanted a lower stock market. And
when was that? That's before my time. I think that's pre-Greenspan, surely.
No, that was last year, that it was financialized, and that they would have liked to have seen a lower stock market and the speculation and weaken the economy. And now everyone's given up on it. And, in fact, Google stock market crash 2023. And in every year, you'd see hundreds of prognosticators out there making their call. It's going to happen in June. It's going to happen in October. You don't see any out there except Jeremy Grantham. He's the only one I found. So there is a lot of complacency out there. No one's worried about a crash in the middle.
Well, I think maybe doing the Fed a disservice to say that they would welcome a crash. I think obviously clearly they want financial conditions to tighten. They want some of the froth taken out. They want some of the froth taken out the labor market. That's just a nicer way of saying they want more people unemployed. Obviously they can never say that in as many words for political reasons, obviously.
But 3,200 S&Ps would have also put much more of a dent in the upper income for people as far as spending. And they're the ones that still have the money to do it. Yeah, so anyway, we'll see. Narratives come and go, don't they? And they say that if you're a forecaster, forecast often.
you might get it right once.
You ever hear that? Yeah, there he goes. Keep throwing that mud against the wall, Jamie. Anyway, buddy.
Thanks, Dale.
Thanks for hanging out with us today. Jamie McGeever, everybody, at Reuters, Jamie.
Thank you. Have a good day, everybody.
All right. Adios, Jamie. Everyone else here could join the team on the Morning Edge. Don't just count your pips, count your blessings. Dollar's weakening. The euro cable spread was the early tell. So we'll see if the market can make hay out of a weaker dollar today. I'll see everyone tomorrow for Turnaround Tuesday. Adios. Thanks again, Jamie.
See ya.
See you, buddy. They're thanking us. See, we edified a few people today. There you go.
Oh, there's a first.
Yeah, mission accomplished.
Nice one. Speak to you soon, Dale. All the best.
All right. Bye.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.